To get into some of these week's top business stories headlines with me today is Bode Ososami, a RISE business analyst. Thank you for joining me, Bode. Good to see you.
Thank you, Rolake, and thanks for having me on your show.
So the first story I'd like us to get into is Davos, cooperation in a fragmented world. That's the theme for this year. You know, some of the leaders have actually taken a back seat because of the optics of appearing at such a trying economic time for many countries. What do you think the signal of that is, the importance of that, and what do you think the main thrust of the discussions will be?
Well, if you consider the main theme, cooperation in a fragmented world, that's very interesting, also very relevant. According to the World Economic Forum Global Risks 2023 report, the cost of living crisis and geopolitical differences will drive what they are calling geo-economic warfare and heighten the risk of multi-domain conflicts. Technology and geo-economic warfare and trade tensions are already worsening inequalities. And I think the main challenge for Davos is how to harmonize solutions when the context can be so different across the globe. Davos has to answers that work for all, and that will not be easy, and I think requires fresh thinking in my view, and the courage to listen to all the communities that will be represented. How do you deal with crisis, energy supply crisis, rising inflation, food supply crisis, global cost of living crisis, climate crisis? And note, these new challenges add to the familiar older challenges like the massive infrastructure deficit, poverty, and tepid growth in developing countries. And apart from the cost of living crisis, there are some very important high impact risks like the collapse of systemically important supply chains, the erosion of social cohesion, and large-scale involuntary immigration. There are topics like how to foster a more effective energy transition. That is going to be quite interesting to watch. I was just listening to the Global Energy Conference going on. The Qatari energy minister, for example, said gas is not a transition fuel, it is a destination fuel, and that developing economies are being confused with this issue. So there's quite a lot. But one thing I must say is the difficulty is we may be solving problems we are creating. And we also need to be able to rethink some of the traditional Bretton Woods paradigms. The World War ended over close to 80 years ago. Things have changed. And sometimes experts are talking from expert silos and they're not really listening to each other. And it's not so easy when you're trying to solve problems that have at their back. If you look at the background, the more fundamental issues are not really being addressed. So can we be bold enough to rethink the institutions, or do we want to keep solving problems that we are creating? But having said that, Davos is a good place to do good deals. You have NGOs venting their usual frustrations on themes like poverty, pushing worthy causes like climate change and decarbonization. One interesting topic is reigniting growth in Africa, where they will discuss policy actions. I think that's on January 19th, to enhance economic diversification and unleash the private sector's massive potential in Africa. So let's hope policy leaders will be paying attention to these issues.
Yeah, and I really like what you said about the need for fresh thinking. Well, a lot does happen in a year, so it will be interesting to see what the outcome of talks will be. The next two issues I want to talk about, I want to sort of take them together because these are two of the world's big economies, the US and the UK. In the UK, GDP in November unexpectedly surprised us. And in the US, inflation, well, I guess you could say unexpectedly also positively surprised us. What is going on in these two really important markets? And is this a sign that perhaps some of the rate hike decisions will be slowed down by central banks in some of these economies?
Well, there's a lot to pack into that, but let me try and make it as brief as I can. There's no doubt that rate hikes are having some impact, although we have to admit that the drop in energy prices is playing a major part in declines in inflation seen to date. And the central bankers are not naive. They know that their tools are limited, and there are many other complex factors beyond rate hikes and quantitative tightening that are impacting inflation, deglobalization, the resource nationalization, trade wars, recalibration of supply chains towards reshoring, onshoring. When you are saying Europe first, America first, UK first, China first, prices are going to go up. The war in Ukraine is also, of course, that's impacting prices. So, and we have skills that are in short supply post-pandemic, and materials also still in short supply after the pandemic. All this is resulting in the inflation, especially with pent-up demand, increasing the demand pool. So 2% inflation, in my view, is a dream. But on the UK situation, I think it was a bit of a surprise to many because, of course, we know the thinking is that the UK is going to go into recession. But if you look at the mix, particularly of how they ended up getting that positive, services pulled up the net figure. Manufacturing was really very, very much lower. And according to the ONS, that's the Office of National Statistics, what they're saying is that the UK would have to see a monthly drop of about 0.5% in GDP for UK to go into recession. And December we had the strikes, but the winter wasn't so bad. So the bottom line is that the world is facing challenges, economic challenges. Many have fiscal issues. The upside, especially in terms of economic growth, is very, very tepid. So I just think it's difficult times. But the good news, of course, in the UK is that positive figure makes it perhaps a little less likely that the UK will go into recession.
Yes, indeed. Interesting. I was reading about the potential strikes in universities across the UK. So perhaps not totally out of the woods yet in terms of some of the socioeconomic challenges that market will be facing. So this last story is a very interesting one because we've heard so much about labor cuts across many tech companies, not just Apple, Amazon, Google. They're all taking cuts. And finally, the top guys, well, Tim Cook, just one top guy, says he's taken a 40% pay cut. Do you think other CEOs will follow suit? And is this just optics and pandering, or do you think this is the right thing to do?
Well, 40% pay cut, that still gives you $49 million.
That's not a bad take-home pay.
Bad situation, I dare say, but I think this is unavoidable. Executive compensation is definitely coming under a lot of focus, especially for big tech. With the pressure, understandably, the recent declines in big tech performance, and we now have more institutional and activist influential investors challenging these packages. The Apple Compensation Committee includes Art Levinson, Al Gore, and he's a no-nonsense chap, Andrea Jang. They're engaging with institutional shareholders, and they say they want to position Cook's annual compensation between the 80th and 90th percentiles relative to the primary peer group. That means that only 10 to 20% of the peer group will be paying more than Apple pays, which makes sense given top market positioning of Apple. The other thing they're doing is that they're skewing the payment to more of restricted stock units, and the actual shares Cook can sell will depend on Apple's performance versus the S&P 500. So far, Cook typically vests the maximum amount, but what we hear is that the compensation committee will not just reduce the total target, they will increase the proportion of shares tied to stock performance to 75% in 2023 instead of 50%. That means if Apple performs woefully, he may just take home $12 million instead of $49 million. But as you know, Apple has been doing so well. It was just $14 a share when Cook took over in 2011. It's now over $130. So the thinking is, yes, Apple dropped over the last 12 months by 24%. That's still much better than the average. One thing I must also add is that best practice is to have more balanced scorecards beyond just stock performance. And the important is the independence of the compensation committee and capacity to challenge strong CEO personalities where this is required, especially in sensitive issues like pay for performance.
Yes, indeed. And it would be good to see whether Apple actually does cause a ripple effect across other tech companies. But I'm told that we still have about 5 minutes to go on our conversation, and I wondered whether you had time to look at any of the top stories we talked about this morning. There was Qatar signing a deal on petrochemicals. There was also Ghana inflation at 54%. Do you want to be drawn on any of those stories? What are your perspectives?
Well, let me talk a bit on the banks, because I found that quite interesting.
Oh yes, the US bank results, yeah.
Indeed. JP Morgan, Citibank, Bank of England, Wells Fargo, these are bellwether stocks. And JP Morgan and Bank of America beat quarterly earnings, while Wells Fargo and Citigroup fell short of quarterly profit estimates. But shares of all four firms rose after an initial dip yesterday. Looking at how they closed yesterday, Bank of America is up 2.2%, Wells Fargo up 3.25%, Citigroup is up 1.69%, while JP Morgan Chase is up 2.52%. So it's not bad after the initial dip. Morgan Stanley and Goldman Sachs will post their results on Tuesday. But the bottom line is that the results confirm that the last quarter data is still not exactly predictive of a recession, which is what we are seeing in the PMIs. They tend to be better than what we expected. But when you look at the outlook, it's that of very cautious optimism, and many are putting aside huge credit risk provisions. Of course, JP Morgan puts aside $1.4 billion. That's huge, and that's a red flag. Remember, the World Bank have slashed very aggressively growth from 1.7%, from 3% to 1.7%. The US is now projected to grow at 0.5% from a June forecast of 2.4%. So banks can't ignore those types of signals. The other thing I must say is that just yesterday, former U.S. Treasury Secretary Lawrence Summers has said that the U.S. economy is still facing a recession this year, despite encouraging news in recent weeks, adding that we have to be careful of false dawns. So yesterday's bank's performance could be another false dawn, but the banks say that they're prepared for any scenario.
Yes, indeed. And it'd be interesting to watch. Goldman Sachs hasn't posted results, but it's cut 3,200 jobs. Is that a sign that perhaps it's expecting not so great performance when it announces on, I believe, January 17? What are your thoughts?
Well, clearly, it has to be. If you look at the expected trajectories of many of these banks, I think the more diversified, flexible, more digital, technology-driven banks may have the advantage of losses in one side of the business offsetting another, and will enjoy maybe better flexibilities than the narrower plays like Goldman Sachs. But how individual banks will perform will depend on the income mix, sensitivity to Fed rate movements, mix of investment banking and fixed income trading business, corporate wholesale banking exposure to consumer discretionary spend like cards, and of course the customer mix, whether it's more on the high net worth end or more of the retail end. And the banks are different. But my sense is there are conflicting trends. Higher rates are helping big lenders earn more interest income, but some of that boost will be offset by larger provisions for expected loan losses.
Absolutely.
As the outcome. Exactly. And of course, investment banking is expected to be very, very weak in the wake of all the frozen IPO markets and subdued deals. Will be partly offset by a rise in trading revenue thanks to market volatility and the boost from fixed income operations. So we see all these types of dynamics at play. But of course, Goldman Sachs is not likely to do so well. We'll see. We'll get the results on Tuesday, as well as Morgan Stanley.
Indeed, and I expect that areas like mortgage lending may also suffer, even though banks' net interest incomes overall may have benefited from the hike in rates by the Fed and other central banks. Well, insightful discussion always, Mr. Bode Ososami. Thanks for joining us and offering your expert insights, as always. Have a lovely weekend and hopefully see you soon. Thank you.